I understand why there's a discrepancy between the Biden headlines and what Summers is saying publicly, because I guarantee you it's all about how you ask a question. Biden probably asked Summers, hey, what are some things we can do to minimize the chance of a recession? Summers gave him his answer. It doesn't mean those things are going to happen. So take that for what you will. Are you in the recession later this year, early next year camp, John?
Brian, we are not. We think we could skirt a recession. That means come pretty close to it. But we think we can skirt it this year. Just the slowing that we've seen in the economy, in our view, does not suggest a recession on the way, but rather that already we're beginning to see some effects, at least from an emotional or a sentiment point of view, in terms of the Fed's dealing with this since it had pivoted in the fourth quarter. We also think that we are going to have a bumpy landing. And if this is, you were talking about commercial airlines before, if this is parallel to a commercial airline headed into a landing, we're experiencing some turbulence. We've come down from 40,000 feet probably to about 30,000, 25,000 feet. We got some turbulence, but it does not suggest we're going to have a hard landing or an emergency landing, so to speak.
Okay, Andre, what's your take? You think recession later this year, early next year, or can we indeed skirt it?
Hello, Brian. It's a close call, but it's definitely more likely than it was a few weeks ago, with Federal Reserve having to tighten policy aggressively to restore the inflation-fighting credibility. We think that increases the likelihood of recession quite significantly compared to previous expectations. The more financial conditions have to tighten, the quicker Fed needs to go, the higher the likelihood recession is on our doorstep.
Okay, so John, given that macro view, what about the stock market? Because it feels like the market's already pricing in, obviously, a large downturn of some kind, call it a recession or not, earnings drop, whatever you want to say. Has the market priced all of it in, or is there more downside to come?
There were sure times last week when it reminded us unparalleled to what the selling looked like in 2008, even though the situation does not suggest a systemic risk at this point, tantamount to what we saw in 2008. But the selling was so indiscriminate and violent that we can't help but think if we're not at the bottom or didn't experience the bottom by the end of last week, that we are actually close to it. So we remain constructive, and beyond that, we're still bullish on equities. We think that's the place to be. We continue to like cyclicals over defensives. The defensives look expensive. You just got to look at the forward multiple, the 5-year average forward multiple versus where we are today. It looks like there's a lot of opportunity out there. It just takes a certain amount of gumption. It's always easy to say, buy low, sell high, but it's particularly hard to do to buy low, and that's where the
John, I'll go back to you on that very quickly. Before I want to go back to you on that. Why is that? In every aspect of our lives, we try to get a good deal, right? Well, it's Amazon Prime Day. I'm going to negotiate that car dealer down. I'm going to come in. In every aspect, we try to get the best deal we can, and yet when stock prices fall, a lot of times we tend to sell into that and then buy back when they're higher. It just doesn't make any sense relative to anything else we do.
It is probably the only industry when the goods are put on sale, very few people show up at the store. The good news is Buffett has shown up at the store recently in size and made investments across a good number of sectors that would indicate likely no recession and some kind of a recovery out of this mess we're in right now.
Yeah. All right, Andre, if it all comes down to rates, if stocks are reacting to fixed income, which is reacting to central banks, then where are rates going?
Well, we think there is a good likelihood that yields need to move higher from here as inflation remains stubbornly high. Further out the curve, there is clearly a risk of a move in an opposite direction as recessionary fears increase. So a lot of the shifts that we're going to see ahead will be more curve shifts rather than across the board. But it's important to mention that when you look at fixed income, when you look at credit in particular, if we are indeed heading into a recession, there is a long way to go in terms of repricing that we need to see. Markets like high yield are not priced for a recession right now. We're definitely priced for a slowdown. That is baked in, but we're definitely not priced for a recession if that were to happen.